Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. Now, there are many reasons why stock prices move. However, if there is a significant movement in share price during this time of the year, it is more likely due to the performance of the company during the June quarter. It is the first quarter of the year and more often sets the tone for the rest of the year. So today let us have a look at 10 stocks from the BSE 500 universe that have reported the best combination of top line as well as bottom line growth. Now the key term here is the best combination of top line and bottom line growth. To put it differently, if a company has reported a very strong top line growth but an average or below average bottom line growth, it will not be considered part of this list. Likewise, a very good bottom line growth but a mediocre or below average top line growth will also keep the company out of this list. The stock will have to have a combination of both the top line as well as the bottom line growth, which is amongst the top 10% of the BSE 500 universe. So, for example, if a company has the 5th highest top line growth amongst all the BSE 500 companies and 50th highest bottom line, then there's a strong chance that it will be a part of the list of the top 10 companies. But if a company has the 10th highest growth but is ranked 100th on the bottom line growth, it may not get into the top 10 rankings. So with this classification out of the way, here are the top 10 companies that have the best combined rankings of year-on-year top line growth as well as bottom line growth for the quarter ended June 2025. Laurus Labs has recorded the highest top line growth of 13x versus bottom line growth, versus it has recorded a bottom line growth of 13 times versus a top line growth of 31%. Its top line growth has been good, but bottom line growth has been exceptional on account of the low base effect perhaps. Up next is Sterling and Wilson Renewable Energy, followed by Signature Global, Maharashtra Scooters, Chalet Hotels, Coforge, Capri Global Capital, Naveen Florin, Sada Energy, and Bajaj Holdings completing the list. Now the median top line growth of this group is 85%, whereas the median bottom line growth is 186%, almost 3 times. Now here's how the share price has done over the last 3 months. The BSE 500 has remained more or less flat over the previous 3 months. This means that with the exception of Signature Global, all the other stocks have managed to outperform the BSE 500 index. The top gainer has been Laurus Labs, whose share price has seen an impressive 40% jump, followed closely by Maharashtra Scooters, recording 36% growth in share price. Now, there are some stocks which are best valued from a price to book value perspective, and there are some stocks best analyzed from a price to earnings or PE perspective. Here are the stocks that I believe can be best valued from a price to book value perspective. What does this table tell you? It tells me that the majority of the stock are trading at a premium to their 5-year as well as 10-year price to book values. For example, Maharashtra Scooters is trading at a 50% discount to its 10-year price to book value, and hence if the stock is worth its 10-year average price to book, the expected upside is 109% from the current levels. Likewise, Capri Global has a 17% upside going all the way to Bajaj Holdings, which actually has a 37% downside. In other words, it's already trading at a significant premium to its 10-year average price to book value. To be honest, Capri Global Capital is the only stock which has a potential upside of 81% or 17% if its price to book value has to go back to its 5-year or 10-year average. Yes, Maharashtra Scooters also has a 109% upside, but that upside is misleading. A change in accounting policy has led to the price to book value ratio before March 2017 being rendered meaningless for Maharashtra Scooters. One can ignore the 10-year upside and focus only on the 5-year upside, which is negative 41%. Now, Capri Global Capital's strong financial performance in recent years is largely due to its strategic focus on high growth retail lending segments. The company has aggressively expanded its assets under management by diversifying into key areas like MSME loans, gold loans, and affordable housing finance. This expansion has been supported by a robust branch network growth and technology-led processes which have enhanced efficiency and customer reach. Additionally, its focus on co-lending arrangements with banks and a strong capital base, augmented by recent fundraisers, have provided the necessary fuel for this rapid, sustained growth. Therefore, there may be a case for taking a more detailed look at Capri Global and its business model. For the other four stocks, however, the risk reward does not seem to be in favor of the investor. Let us now look at the other five stocks and see whether there is any chance of any upside potential in them. Well, with the exception of Coforge Limited, all the other stocks are already trading at a premium to both their 5-year as well as 10-year average PE multiples. In fact, even for Coforge, the upside is merely 2%. Therefore, the risk-reward equation of investing in these stocks from a 1 to 2 year perspective is certainly not in favor of investors when considered against their historical valuation multiples. Does this mean that one should not consider investing in these stocks at all? Of course not. I have analyzed these stocks using my own framework where I need a significant margin of safety in valuations and not momentum before I consider investing in any stock. Based on my framework, the risk reward is not in favor of investor in none of the 10 stocks with the exception of Capri Global Capital. Even here, a detailed analysis is required. Now, if you think you have a better framework of investing which is logically sound and which has worked for you over the long term, you can certainly consider using the same and see what it leads to. There's also a bigger lesson that one can walk away with from this exercise. The fastest growing companies do not necessarily make the best investments. If the growth is already captured in the current stock price, and if the stock is already trading at a significant premium to its historical valuations, then investing in such stocks could actually prove to be negative than positive over the medium term. Well, that's all from me today. I'll see you again in the next session. Goodbye and happy investing.